Hello, and welcome to this episode of To the Point. I'm Neil Stanley, and today we're going to talk about shifting the focus from rates to profits. As we do this, we need to observe the classic definition of profit maximization is that marginal revenue is equal to marginal cost. Now, it's very intuitive that we should not have marginal revenue below marginal cost. It's just obvious to the casual observer that if our marginal revenue is less than our marginal cost, we've reduced profitability. What we want to talk about today, though, is something that's a little less obvious to some, and that is that we are also suboptimal if marginal revenue is above marginal cost. Community financial institutions today seem to be ignoring this issue, so we want to address it. Recently, I posted in IntraFi's Peer Intelligence an observation that we have been observing large banks having low cost of funds over such a long period of time that maybe bankers are unaware of what has flipped. You can see on this graphic that at the end of 22 and into 23, we went from having the red and green lines, which were the cost of funds for the lowest cost of funds, the largest ones, were steadily the lowest cost of funds. But what happened is those larger financial institutions in recent quarters have had the highest cost of funds. We need to ask ourselves, do you think that that is unintended? Do you think that they are foolish? Is there something that they are missing? I don't think so. If we think about the revenue side of this, we find that the marginal revenue, which is equal to effective Fed funds, if you get another dollar of deposits, you can put it in Fed funds. That rate is 5.3. It's not even on this graphic. It would be up here somewhere. So if the marginal revenue is 5.3, we can't tell exactly what the marginal cost is. We know that it'd be something above the average cost. But what we also can conclude pretty easily is that it is financially effective to be paying a rate that is holding deposits and taking deposits from competitors if you're creating a nice spread. So after this article was published, I decided to publish another article, and today in LinkedIn I posted that article, and I talked about the bank management team focused in on maximizing profit or merely holding down cost of funds. These two approaches do not deliver the same results. So we took data from the FDIC quarterly profile. That's what we represented earlier with the various sized financial institutions. And we focused in on this issue of marginal cost and marginal revenue. That article was published today in the Financial Brand. We talked about the rate cuts being delayed from what was previously expected and how banks can boost profitability by focusing in on volume. It's increasingly likely that expectations for rate cuts are being delayed. And the secret weapon is to focus not on price, not on the rate market saving us from a higher cost of funds, but taking a reasonable cost of funds and expanding the volume, getting more business. So we went through some economic analysis, which included understanding the inflation rate by looking not just at the year over year, which is this first graph, but looking at the monthly compounded, which we find that the inflation rate in recent quarters has been closer, in the recent quarter has been closer to 3.5 to 4.5%. That's going to stall any notion of significant rate cuts if GDP continues to grow, which the GDP now is forecasting a rate around 4, while the economists are thinking about 2. Either way, those things, if those come in anywhere close, we're not going to have a falling level of economic activity. We also are noting the unemployment level is at historically low levels for this century. So if interest rates don't fall, and even if they do, we need to get back to focusing on profitability rather than just holding the line on cost of funds. So profitability is a function of getting volume, having better negotiation tools, having the ability to win, whether we're talking about the sleepers, the curious, or the shoppers. How do we negotiate with them? And this article talks about a funds transfer pricing process where we measure results consistently each and every period so we see what we're booking, the volume and the spread on that volume. And then when we look at it through that lens, we understand that, yes, these financial institutions that had the lowest cost of funds now are moving up in cost of funds, but it's not irrational. It's quite rational. And if Fed funds stay anywhere above 4.5%, you want to be able to price in such a way that your marginal cost is equal to the marginal revenue. So I hope that's helpful for you just conceptually. To make it even more practical, we have built the term funding profitability analysis. When we click on this link, we go to a section called the term funding profitability or profit benchmark. And what it's doing is it's coming up with an industry level benchmark, and we're going to produce this each month to show how high performers are dealing with this. And we're measuring the rates that they're offering and the spread to FHLB advance rates, the volume that they're booking. And when you put that spread and volume together, you can see the profit on a common size level. We're going to show a few of our high performers, what they did for rate, spread, and volume. We're going to be reporting that on a consistent basis. So if you're one of our clients, you're already going to get this. If you're not, you too could be in line to receive this information by by contacting us and working with us in that regard. So what we want to do is move into a situation where you feel very comfortable reaching out, setting up information, a time to gather this information from me. You can set up an appointment using my calendly.com/Neil-TheCorePoint link. Just go ahead and reach out to me. You can find that on our website or on my emails, or just take this link off of this site. I want you to know how much I appreciate the opportunity to present this information to you, as it's going to really move the needle for financial institutions who are looking to be high performing. It's a pleasure to provide this information. I look forward to hearing from you and presenting the next episode of To The Point in the near future. Until then, make it a great day.